Right, hi. So this is TYU4. Um, let's look at it. I mean, you're not going to get this type of question in the exam where they ask you to perform both. It's not, doesn't work. This is just it's an exam, it's a chapter question, so they want to just sort of express the full sort of range of questions that you can get. So let's go. So as usual, I'm going to spend time on the workings and then just take you to the answers and sort of match them up. And the workings are what's really critical. That's really the important point. And I hope you have to have read the question, pause this, have a go at the question, go as far as you can. It'll take you a while. It can take some time, but go as far as you can. But critically, what's important again, like I say, is understanding the workings. Right. So I think what's a good idea is to kind of sort of just be sure that you understand that P is in control here by 70%. So non-controlling interest is 30%. Remember, this is 3 years ago. So there is a slight difference. The income statement or the statement of profit or loss will only show the yearly effects, while the consolidated will show the effects over all the time. And that's not tricky. It's just making sure you include everything. Okay, right. Financial statements of each as follows. You have all this lovely. Oops, sorry. You have all this really good information here. Pretty straight. And you have statement of profit or loss. So let's jump in, and I'll just do each as we go along. So first things first. It says here that Satago plant at the date with the carrying amount of 100,000, but the fair value of 120,000. So I'm just going to do that here. I'll just call that working 2. So really, you have net assets at acquisition, net assets at reporting, post-ac. This is like you're working 2. And this will help us for anything. So let's look at the net assets at acquisition. So that would have been the share capital plus the retained earnings, which is given to you. They always give that to you. So that's 150,000 plus 430,000, right? So 150,000 and then 430,000 for the retained earnings, and that's the ordinary share capital, right? And then, so this of course will be 150,000, and we also know that I think it's 700,000, I believe, I'm sure, yes, 700,000. There it is, by the end of 3 years. So these are the events over, if you like, a 3-year period in effect, if you like. So the first thing is we are told that it says there that it says here that there was a plant, 100,000, but a fair value of 120. So that means that, I'm just going to change my pen color. That means that what I should really be doing is I should be putting a fair value adjustment here of 20,000. Now it tells us as well, that this plant was to last 10 years. So that means that the depreciation would have been, 20,000 over 10 years. So that's 2,000 each year. So over 3 years, we would have 3 years of depreciation, and therefore we would have £6,000 coming off this. So you would have £14,000. Are you happy with that? It's a 3-year period. Don't get me wrong. In the income statement, when I look at the income statement, I will only see depreciation of 2,000. So when I say the statement of profit or loss, when I'm doing that, it will only be for 2,000, right? Because that's just the 1 year. But of course, in this scenario, I will see all 3 years. Good. I think it's a great question because it does bring it all together, so you can sort of see what's going on. All right, so let's see. That's the first thing. And then, so again, like I say, 2,000 will be charged to cost of sales, and you will see that sort of 6,000 drop right across working 2, right? When you do that, you'll see that 6,000 drop right across working 2. Okay, who's next? The next one says that the pillar values the non-controlling interest at fair value. Fair value good, so that's nice. The fair value of the non-controlling interest is 250. So now we need to calculate goodwill. So I don't have any space here. Let's go over here and do goodwill right here at the bottom. So goodwill, of course, will be what I've paid. I own what percentage? I own 70% of this. So I own 70% of this business. So 70% I own, sorry. So what's my consideration? Then of course there's the 30% belonging to the non-controlling interest fair value. So those are the two. That's your total thing, right? I need to find those. Less kind of net assets at acquisition, fair value of net assets at acquisition. Now, let me do this one first. Fair value of net assets at acquisition is this business over here. this plus this plus this, right? And this looks like 600,000. So I know what the value of those net assets are at acquisition. That's what you're buying. That's what you're buying. They tell us 70% consideration. We can see over here that what did you pay for it? It says that you paid for your 70%, you acquired 70, and you pay investment in S at cost. It says that you paid 700,000. So I know you paid 700,000, and if I look for the fair value of the company, they tell us it's 250,000, right? Yes, so 700,000, and you paid, well, the fair value of the non-controlling interest is 250,000. Let's just check that again. Yes, 250, and your business up here, you guess 700,000. Which means that the total consideration, of course, is 950,000, which means that goodwill is 350,000 at acquisition, right? But then they tell us that goodwill has, that we have a problem. Goodwill is impaired by 30% at the reporting date. So technically I should then sort of, well, I mean, of course, as a whole of my income statement, of my statement of financial position, I will take a third of this, and a third of 350,000 divided by 3 is, sorry, a third, sorry, it's not a third, it's 30%. I mean, careful, it's very important. 30%, so 30%, so 0.3 times 350,000 is 105,000. So over the 3 years, we've had a fall of 105,000. So technically, I should do 1 over 5, 105,000 there. But only a third of this relates to my year. So what will actually go through my depreciation in my statement of profit and loss would be 105,000 divided by 3, right? It tells me that it's 35,000. So that's 35,000. If you like, going through my year, 35,000 through my statement of profit or loss, but this whole thing will go through to my statement of financial position. Right? Cool, great. That's that, and that's that one. That's kind of what's going on here, and that's kind of the extreme of it. Okay, great stuff. So let me do. I did a kind of a similar version of this, but let me do the. Let me see if I can. Well, now that I'm in writing mode, it won't let me create a new page. Let me see if it'll let me create a new page. Doesn't matter, I can use double entry. And I like doing it in double entry so you can clearly see what's happening. This way you know exactly what's going on. Okay, so you have an asset sitting there, and it tells you that your asset had always been sitting in there, again, for, at 12 grand. Always been sitting nicely in there, 12 grand. And it says that under normal circumstances, you would write this down over 3 years. Yes, I believe 3 years. And technically, your accumulated depreciation would be 4. If I did that right, technically, if that's what had happened, over 3 years would be 4. And my net book value technically would be 8. It's just so that you know that in your mind. You know that you'd have done 12,000 minus 4,000, and then you would have 8,000. Right? But no, you decide to dispose of this thing. If you like, when I say disposals, if you can visualize my fingers in quotes. So when you dispose it, I'm just going to create a disposal account, right? You say, okay, I'm getting rid of this, 12,000. You then sell it. I'll change my pen color. You sell it to your subsidiary. So this is asset parent for 15,000, if you like. So your subsidiary is literally bought an asset for 15,000. So they've got the asset for 15,000. If you like, I mean, debit subsidiary asset, credit bank. Key point is you've disposed of it for 15,000, and you have 15,000. Whether it's a receivable or a bank, it doesn't really matter. But the key point here is that you've disposed of it, and you have realized the gain. You've realized the gain on the sale of this asset of £3,000. That's how we deal with this. That's how you would record this under normal circumstances. So you now have this gain, and this gain is sitting in your retained earnings, Mr. Parent, right? And it shouldn't be there. Anyway, let's carry on. Subsidiary now says, okay, this thing has 3 years left. So subsidiary now does this, now depreciates and goes depreciation 5, and accumulated depreciation 5,000. That's what's showing in the accounts. Parent hasn't depreciated because, they've gotten rid of the asset. So the subsidiary is now showing this. Let me change my pen color. Now, what's really happening, isn't it, is that this asset really should have a net book value of 8 in effect, and depreciation really should be 4 in effect. So we can really, the master stroke journal is really actually to debit, if you like, retained earnings with 3, and because you see currently the asset is now showing as 10, and to credit the asset, if you like, credit the asset, because 15, net book value is 15 minus 5, right? So to kind of put another 2 there, and to put 1 there, if you like, against depreciation. Because this brings depreciation back to 4. This brings the 15 minus 7. This brings the asset back to 8. So this would have been the double entry that you would put through the journaling. But from a thinking, conceptual point of view, it's currently showing at 10. I need to bring it down to 8, knock off 2. Depreciation is currently shown at 5. It needs to show at 4, knock off 1. And then, of course, that profit that you never really realize, you reduce it. This is what I was saying. So why I didn't do it in class the first time, because I wanted you to sort of conceptually sort of see what was going on. So that's what's happening with that. And that's how we're going to treat that. Okay, great. So I'll do one video. This video will just be for the adjustments, and then we will then apply it to the answers and sort of mop everything up. But that's the important thing. So this is going to go, this 3,000 will hit your statement of financial position, working 5. Yes, because that's the retained earnings of the parent. I think it said you sold it in that year, at the start of the year. So you will now hit your depreciation you will reduce your depreciation with 1, if you like. And in your assets, on your statement of financial position, you will subtract 2, right? Because this is in the statement of financial position, all of this here, this bit here. But this bit is in the income statement. And it all kind of balances out. Okay, great stuff. So let's look at this one. At the start of the year, that's what we've just looked at, right? So this is a perp, and I'm sure you're happy with this, but let me just create some space, see if I can get myself a new page. Will it give me one? I need a new page. I need a new page. I'll just create a new page. Create a new page there. Okay, so let's look at what it's saying. The argument was pretty straight. Satago is the subsidiary. So subsidiary sold goods to the parent. So let's just deal with that first. Sold some goods for 60,000 at a markup of 20%. So let's just deal with that first. I'm just going to make it as practical as possible. Sold some goods, 60,000, the markup of 20%. So if it's I believe a markup of 20%, this is at 1.2, right? Or at 120%. So the question here is, well, what is the real cost of these goods? So that's 60,000 divided by 1.2, right? So 60,000, I know 60 divided by 12. So that's 50,000. So technically, this is the situation. You have goods worth 50,000. And then you have a markup sitting there of 10,000. That's what you have right now, because that's technically the profit you put on it when you sold this thing, when Satago sold it. Now we need to see what's left of this. It says that 40% remain unsold. So that means that of this thing, 40% here remains unsold. They've sold 60%, so that means there's 40%, of course, of this perp, which is 40% of 10,000, which is 4,000. So there's a pup of 4,000 sitting there, unsold profit. It's unrealized profit sitting there, 4,000. Right? So it's in the parent. So I need to debit the retained earnings it's in the subsidiary of Satago in working 2. So I'm going to come here. Oops, sorry. I think I'm in the page. Oops, sorry. Of working 2 of Satago and credit inventory of 4 grand. Nothing's different. It's just exactly what we've been doing so far. Who has the profit? Debit their retained earnings. They shouldn't be having profit that's inflated. And that's how we would deal with that. And that's the pup. Then let's look at so that's that bit. And at the year end, it says the Satago's books show a receivable. So let's look at it. So we have here Satago show a receivable of 6,000, whilst the other forgotten the name of the other. Well, not forgotten. I just lost the name of that other company. Papilla shows a payable balance of 1,000. So what you have here is Papilla shows their trade payables of 1,000. Satago is showing 6,000. And the only reason this can happen is because Papilla has sent a check to, if you like, so Papilla has done really what's really happened here is that you had 6,000. So Papilla sent a check of 5,000, if you like, coming out of the bank, right? Bringing this down to 1,000. Satago hasn't got the check yet. So we have to make the check arrive. So in Satago's accounts, we need to debit bank with 5,000 and credit Satago's trade receivable with 5,000, which is technically deducting 5,000 from trade receivable. So now we have 1,000 left, and we can now cancel both out via the intercompany accounts, right? We can now cancel both out because there's only 1,000 left here and there's 1,000 left here. So we can just, if you like, journal both out or cancel those out. Right, and then we have the final question says that then Satago paid a dividend on all their shares. That's always the case. Paid a dividend on all their shares. So we cannot show dividends. We need to. This will show, of course, on the statement of financial position, and you will take it out, of course. Sorry, the income statement. You need to get rid of that. Its own share. So you have 70% of this business. So 70% of 20,000 is 14,000. So you will need to deduct 14,000 from your investment income. Papilla will need to deduct 14,000 from its investment income. Cool, great stuff. So I'll end this video there, then I'll go to the answers and then sort of show you how everything then sort of pans out. Okay, great stuff. See you in the next video.